Welcome to WealthEchelon, your go-to destination for expert insights on finance, stocks, and ETFs. Our mission is to empower you with the knowledge and strategies needed to navigate the financial markets with confidence. Whether you're a beginner looking to build a strong investment portfolio or an experienced investor seeking market trends and analysis, we've got you covered. Join us as we break down complex financial concepts, explore market opportunities, and help you climb the ladder to financial success. Subscribe now and take control of your wealth journey. Warren Buffett and Berkshire Hathaway just sold a bunch of the S&P 500. They keep hoarding cash, so this is looking bad. What should we as investors be doing now? Looking here at this post by Warren Buffett's stock tracker, I noticed that Berkshire Hathaway fully exited the SPY and VOO holdings, which means they fully sold out of the S&P 500, which is definitely concerning. It's also concerning that Berkshire added a bunch of Domino's pizza because Papa John's tastes way better, and it's not even close. Come on, Warren, seriously. Let me dive deeper with you so that you can understand, and I'll also explain a bunch of his other moves because it looks like he's trimming a bunch of the financial sector and getting out of financial stocks, which does not look good for the financial sector in general, or at least what he thinks. Warren Buffett held a bunch of money back during the early 2000s dot-com bubble and the 2008 financial crisis. He saw some of the writing on the wall and didn't FOMO in when everybody else was trying to get that easy money. He was buying up solid, sustainable businesses that produce solid cash flow and relatively fair valuations, while everyone else was jumping in on the things that were super high valued or overvalued just because they were all the hype at the time. Then when everything came crashing down, not only did his portfolio not drop as substantially as his peers, but he also had a crazy amount of cash sitting off to the sidelines, ready to pounce. The Globe and Mail said it best here. Historically, Buffett has argued for keeping large capital in hand to guarantee Berkshire Hathaway's capacity for quick and forceful response when prospects present themselves. From this vantage point, cash is a tool in the investment playbook for both defense and attack. From a defense standpoint, it provides a barrier against financial uncertainty, enabling the business to withstand economic downturns free from the agony of selling other assets at bad times. Cash gives unmatched flexibility on demand. It helps Buffett to seize unanticipated prospects requiring swift response, often during market crashes or when unusual assets lose value. Buffett's ability to buy significant interest or entire businesses at reasonable prices, free from outside financing, depends on this flexibility. Buffett makes sure Berkshire Hathaway can always make decisions that others, who might be over-leveraged or cash-strapped, cannot by keeping liquidity. This strategy emphasizes a basic aspect of his philosophy. Cash is a tool to take advantage of the inefficiencies in the market, not as a static part of his portfolio. With that much cash sitting off to the side and ready, one can make very fast and strategic purchases when other companies are going to have to figure it out and may need time to free up liquidity in order to make that same decision. Warren Buffett has been the pinnacle of patience, which is just so hard to do. Now you may be looking at this and saying, well, why does Martin say not to time the market when Warren Buffett definitely has way more money than Martin and is definitely a better investor than Martin, and he's definitely timing the market? Well, it's not just Martin saying that. Warren Buffett says the same exact thing. For you as an investor, I'd like to ask both of you, if you were 30 years old again and had your first $1 million in the bank, how would you invest it, assuming you're not a full-time investor, you have another full-time job, and you can cover your expenses with other savings for about 18 months? No dependents? Well, I'll be very simple. With the conditions you name, I'd probably have it all in a very low-cost index fund, and it'd probably be, might be Vanguard, somebody I knew was reliable, somebody where the cost was low. And because you postulated that you're not going to become a professional investor, I would recognize the fact that I'm an amateur investor, and I would feel that unless bought during a strong bull market, which this hasn't been, I would feel that that was going to outperform, to a degree, bonds under current conditions over a long period of time, and then I'd forget it and go back to work. It's in the nature of things that you aren't going to have a whole lot of screamingly successful professional investors. You've got a great horde of professionals taking super profits out of the system. most of them by pretending to be professional investors. And that is in the nature of things too. But if you don't have any rational prospects of being a very skilled professional investor, of course, you should compromise on some simple thing, like an index fund. So right there, he's telling you to stick to an ETF or index fund with low fees that tracks a broad market index, something like the S&P 500 or the total U.S. stock market. Plain and simple. The reason why you're not going to do well with Warren Buffett's approach of timing the market is because you're not Warren Buffett. You're likely not a professional trader, and even if you are, you're probably not consistently beating the S&P 500. Like he says right there, if you don't have any rational prospects of being a very skilled professional investor, of course, you should compromise on some simple thing, like an index fund. Yeah, and you will not get that advice from anybody because nobody gets paid to give you that advice. And so you will have all kinds of people telling you how much better they can do for you than that, and how if you just give them a wrap fee or give them commissions or whatever it may be, they will do better. But they won't. On average, 1,000 other people like you doing the same thing, that group of 1,000 will do worse if they listen to the people that make pitches at them. And in the end, why should you expect? You got a very perfectly decent return over a 30 or 40-year period by doing what I suggest. And why should you expect more than that when you don't bring anything to the party? The salesman will tell you that you'll get it, but you won't. Now that's just a straight mic drop. Be careful with financial advisors. I sometimes get heat down in the comments section saying that I'm not a financial advisor. Well, I'm very proud that I'm not a financial advisor. I obviously can go and take the test and pass it and call myself a CFA or CFP, but I'd rather give you the real information for free here on YouTube because my goal is to help people, not add to the problem and keep scamming people out of money. Also, most of the people that give me that heat down in the comments section, I later on find out that they're a financial advisor, and they're definitely just mad because I'm giving you the information for free, and they would rather charge you for this. You definitely don't need them. You can absolutely do this on your own and get that financial freedom. So like I was saying earlier, Warren Buffett made some other pretty big changes within the portfolio in the last quarter. The company trimmed its stakes in Bank of America to 68.2 million shares with a value of $29.9 billion from 79.77 million, new holdings to 40.2 million from 56.4 million, Citigroup to 14.6 million shares from 55.2 million, and Capital One Financial to 7.45 million shares from 9.10 million shares. It increased holdings in Sirius XM to 16.1 million shares from 105.2 million, OXY to 264.0 million shares, and Domino's Pizza to 2.38 million shares from about 1.28 million. It maintained its largest holding, Apple shares, at 300 million shares valued at $75.1 billion at the end of the quarter. A stake in another of its largest holdings, American Express, also remained unchanged at 151.6 million shares, valued at about $45 billion. Now, as far as the S&P 500 exit that Berkshire Hathaway went through, it's kind of interesting to me that they even held any S&P 500 at all. That's it for today's video. If you found this helpful, don't forget to like, subscribe, and turn on notifications so you never miss an update. At WealthEchelon, we're all about helping you navigate the world of crypto, investing, and financial growth. Have any thoughts or questions? Drop them in the comments below. I'd love to hear from you. Stay sharp, stay invested, and I'll see you in the next one.